Hello traders, the title of the video is second step to mastering a common price structure in the financial market at part 2. Alright, so if you have not watched part 1, we highly recommend to trader to watch part 1 of this series of video that we call mastering common price structures in the financial market. Alright, the price structures that a stock trader, a stock investor, financial market trader, financial market investors must know. Those are common, price structure that are essential in the financial market. Alright. So the talking about second step to mastering a common price structure in the financial market, part 2. If a financial instrument, whether stock, commodity futures, indices, gold, silver, has trend. So I'm using here the bullish example. Alright, so it's trending, so it trend from point A to point B. Area wave traders will definitely know whether the trending phase has ended. So you may, if you are ordinary trader, asking the question, say, Joel, how do I know that the trending phase has ended? I will say to you, go and subscribe to 24 Elliott Wave YouTube channel. Digit 2, digit 4, Elliott Wave YouTube channel, or go to www.24elliottwaves.com. Alright, to start learning about the Elliott wave. We talk about the lower degree wave count and the higher degree wave count. This allows us, to forecast the market. But we also talk about the motive wave. This is about the price structure, alerting Elliott wave traders that are eagle eyes market participants. If you allow me to say that, looking at the price structure, they will know that the trend has ended. Right? So if a financial instrument start a trend and the trend has ended here, all right, the second common price structure that one must know is that very often, not always, not 100% of the time, but you will see more than 70% of the time, the price will try to revisit the zone between the 50% and the 61.8% Fibonacci retracement level of the trending phase. It's a phenomenon. It's something. If you're in the stock market and you do not know about this common price structure, it's bad. It's bad. But if you do not know, and this is the first time you know about it, so it's great. So don't feel bad about it. But it's so important to know that common price structure. Okay. So we're talking about the first common price structure. Check that video about the first step to mastering common price structure in the financial market, part 1. This is the second step to mastering common price structure in the financial market, part 2. So a lot of experienced traders may be saying, John, you are not sharing anything new, all right? We already know this. I agree. A lot of our experienced traders already know this, but we don't want to forget the new traders. But also, I would like to encourage those experienced traders to stay with us as I'm going to talk more about what is happening here and what to expect, and talking about some specific patterns. All right. So here we are looking at this stock. Alter, Gallagher, and Cooperated, belonging to the financial services sector, did the trend from 1989, where you born that time, up to 2001, 2002, in fact. There was a trend first, and then the correction has begun. And we're talking about correction is a time when those who bought the stock before decided to take some profit, or think that the stock is overbought, and they start coming out because they don't want to buy it again anymore. They wait for the price to be discounted to become reasonable, to return to its fair value before they will buy again. All right. So after the trend is completed, the correction, which is a profit taking or harvest time, will bring the price very, very often into the zone of 50% and the 61.8% Fibonacci retracement level. So I'm using the word Fibonacci retracement. If you don't know about Fibonacci retracement, subscribe to Day Pro Traders YouTube channel. All right. So you apply Fibonacci retracement to the trending phase, and you highlight the 50%. Can you see 50% where my cursor is? 50% Fibonacci retracement, and the 61.8%. Why usually take place? Professional will highlight those key levels to draw it there. So you say, George, I already know that. I already know that. George, I already know that. That you talk about it all the time. George, you make me sad. All right, don't worry. Now, there are more to this. All right. So those who usually buy like this are aggressive market participants. So sometimes they have a good reason to do that because some of those market participants are long-term market participants. So they know that they know the book value of that stock, all right? Especially if the price return to the 50%, 61.8% Fibonacci retracement zone, and is below its fair value, its book value, those investors do not care what the world is telling them. They will just keep buying and buying and buying it, especially if they have excellent management in place, excellent product, and that company keep gaining more market share. And looking at that specific sector here, we are talking about financial services sector, and the future is brighter for that stock. Those investors do not wait for anybody else. They will just keep buying that stock because they believe in the management, they believe in their product, they believe in their policy, and they just buy. They keep buying at between 50% and 61.8% Fibonacci retracement level. One more thing. Stock that are very, very bullish, very dynamically bullish, will usually find it very, very difficult to break below that 50% and the 61.8% Fibonacci retracement level. Right? Dynamic, what I call bullish cow. They want to run away, they want to run fast up. They find it very difficult. They usually find a support there. This is the characteristic of bullish financial, strong bullish financial instrument. We usually find it very difficult to break below the zone between the 50 and the 61.8% Fibonacci retracement. What usually happens, which I need to tell you, is that sometimes some stock will come back to that zone and they will find a support. Price will bounce up a bit, and then it will rally up to the 50% Fibonacci retracement of that correction. So, what am I talking about? That's a very good question. All right. Let's look at it more. As you ask that important question, what am I talking about? George, what are you talking about? You stupid boy. All right, now. Okay, we are talking about applying Fibonacci retracement to the correction, yes or no, right? Before we were applying it to the trending first, now we are applying it to the correction, okay? So if the price did find a support between the 50% and 51.8% Fibonacci retracement level of the trending first, if there is a bounce, people they usually order here to buy. Bounce, you bring it into the zone of 50%, okay, of that correction. So that 50%, that's the first reaction that we will expect. Okay. Here it is. Going to that zone, he goes 1, 2, 3, and the line that I'm going to color now into pink, that's the 50% Fibonacci retracement of that correction. Reaction, there's a reaction there. For area wave trader, we know it. Sometimes the price will go to the 50% Fibonacci retracement of that correction. If I move my line down a bit to adjust it like this, I prefer it like this now. Alright, or 50%, okay. If you find a resistance here, it continues to go down. Sometimes the price will form what we call a zigzag pattern. A zigzag pattern is a 3 components pattern. Zigzag. Okay, so price go first part of the correction, second part of the correction, third part of the correction, forming a zigzag pattern. So because the stock, if the stock is not dynamically bullish stock, as people usually will tend to buy between the 50% and the 61.8% Fibonacci retracement level, all right. As it reaches the 50% Fibonacci retracement level of the correction, talking about the correction itself, now those who do not believe that they should buy it here will start selling again forming, okay, the last part of the zigzag pattern. So a stock that is finding a support between the 50% and the 61.8% Fibonacci retracement level of the trending phase, all right? If it failed to go above the 50% Fibonacci retracement level of the correction, there is a high chance that we may see a zigzag pattern. All right. Generally, financial instruments that do not have a strong balance sheet, or they are not dominant, so to speak, they do not have monopoly or leadership in that sector, may form that zigzag pattern. It's not always the case, but this is what we see very often in the financial market, as we are talking about the second step to mastering common price structures in the financial market, a part 2. So things goes like this. There was a trend in first, price pulled back to the 50% Fibonacci retracement level. If that stock is dynamically bullish, sometimes you'll see something like this. It bounced up to that 50% Fibonacci retracement level of the correction, and then you try to go back to form the zigzag pattern. But because it's a dynamically bullish stock, as it come back to that zone between the 50 and the 61.8% Fibonacci retracement level of the trending fell, there will be bias again for the second time, forming a gorgeous bullish chart pattern. Something like this. That's why I say to you, stock that are dynamically bullish cow that are always going up, creating more value. First, those stocks, you'll see that they will dominate that sector. They will be leaders in that sector, and they will be gaining more market share, creating excellent product. And for those reasons, people are always here to buy between the 50% and 61.8% Fibonacci retracement. So as the price touches that zone for the first time, people are buying. So there will be first reaction as some courageous bearish trader try to sell it out, come back to the same level. Now buyers will resume buying, forming a double bottom chart pattern, and the price continue to gallop, to go up big time. All right. But the second scenario is that some stock, they are not leaders in their sector. So therefore, what usually take place, price come to 50% Fibonacci retracement level, some courageous buyer come and buy. But smart money look at the balance sheet and say, no, these people they will struggle a bit for a while. We come buy here now, so probably form instead a zigzag pattern. So as it come to the zone of 50% level, they say, oh no, bounce to the 50, so it goes into the zone between 50% 61.8% Fibonacci retracement level of the trading phase, and then you rally up to the 50% Fibonacci retracement level of the correction, and then you find a resistance there, and then forming a zigzag pattern. Remember that the third leg, first leg, the second leg, third leg of the zigzag pattern can stop at the 78.6% Fibonacci retracement of the trending phase, or we bring it all the way to the 100% level, which means to the cycle point of the trending phase. So if you are in a financial market, you need to know what's going on. So if we see a bullish chart pattern in the zone of 50% and 61.8% level, we will be happy to take it. All right. If the stock fund is bounce up, from the zone of between the 50% and 61.8% level, start going now, which level should we watch? We should watch the 50% Fibonacci retracement level of that correction. But now, looking at this particular stock that we are checking out today, you can see clearly what's going on here. Hold on a second as I clear a bit by chart. You see now, so we go a bit deeper and deeper and deeper. So this stock, there was a trend in phase, and then the price pulled back to the 50% and the 61.8% Fibonacci retracement level. He tried to go up. He hit that 50% Fibonacci retracement level of the correction. That's expectation. There was a reaction. People were here trying to sell. That's true. But look what the price did. This is a bullish cow, yes or no? It's a bullish cow because they tried to sell it here, but what he carefully did, he break above that 50% level and negate that bearish trading setup. Remember the negation of trading signal? This is the negation of a bearish trading setup. So people often will sell, will try to sell here, pull back to 50%, 61.8 zone. Going now, we are watching 50% Fibonacci retracement level of this move down. Good reason. Always. Why people try to say, because it's happening all the time. You see, it's happening all the time. What has happened before, it's likely to happen again. There's nothing new under the sun. Ecclesiastes, all right? So this is what's going on. So people try to play with the past, to use the past to forecast the future. Now, we can also go a little bit deeper talking about the characteristic of the financial instrument. You may say, Joe, what are you talking about, characteristic of financial instrument? Now, we can talk about all kind of things. Here, this stock was quite bullish. It's just a step above it, kick out the bearish trading, and then form a support. Look at the reaction. Look at this kind of bar. They were just ordered here to buy. People say, don't try to sell this stock. Go away, please. You bearish sellers. That's why he's telling you this one. Okay. And then he just ran away and didn't turn back so far. So this is the second step to mastering common price structures in a financial market. If you have any question or suggestion, please put in the comment section. And in due course, I will be recording another video to answer your specific question. I always read the comment. Your feedback is very important to us. Oh, George, I like this video. George, this is a useless video. The sound was not very clear. You were speaking like a little child. Or you are speaking like your mother today, George, and so on and so on. Those feedback will help us to improve the next recording. If you like this video, feel free to give us the thumbs up. That will tell us that, okay, George, today you have done a very good job. Trader like this video. So I'm happy about it. Okay, then we see the market down. So if you do not like it, mark it down. Then I say, okay, George, next time you have to work harder to get, the attention of those demanding technical traders. Alright, but if you think this is an amazing tutorial, share it so we have more subscribers on our channel. So I say, well done. Okay, so we know where to push this channel to make it an amazing YouTube channel where all technical traders will subscribe. This will conclude our discussion today about the second step to mastering common price structures in the financial market, part 2. Happy trading to you all and speak to you as soon via the TSTW24 traders. Happy trading to you all and speak to you as soon. Good.